Ghanatube sunye and sama koso ewo on my name aha and I was ebekanina model for slow with my science of atanasi. There is some ko eba ede ebra sane matana city na we see kwa koje and semo ede aba ebusia for ye ba na matwa so amo.
I could not hear your good morning. Yes, let's start the day well. So let me thank the organizers for putting together this program. It's an important one. It's good we engage in the debates. And for us at the Central Bank, we encourage these. Yesterday, we had a good meeting with the fintechs that are involved in the remittance business. And I believe that that approach is more efficient. We listen, we hear you, and together we agree on the reforms. It should not be top down all the time, but it should be consultative. Let me assure you, this is the approach we are going to use going forward. So more of these debates, anytime you put it together, we are happy to be part. Now, when I got in here this morning, somebody asked me, Mr. Governor, I want to ask you what you have been doing since you came in. And I said, yes, I welcome that very much. It's about 5 months now in the job. Remember, we came in at a time when the IMF program was actually, off track, virtually, derailed. Inflation was very high, if you remember, over 24%. The exchange rate was out of control. There was so much uncertainty. As a matter of fact, when we had the first meetings with the IMF team, there was a lot of pessimism. That was thinking about, should we just cancel the program and start all over again? But we decided to take the bull by the horns. And I believe that in the last 5 months, we've taken some very, very major decisions. Decisions that underscore the progress that we are seeing now. And so therefore, there should be no doubt about sustainability. Somebody asked me, do you think you can sustain the stability of the exchange rate? And I said, have you read the background data? These things should be informed by the evidence. Everything is out there in our statements. If you go to after MPC, we put out lots of data. But it appears in Ghana, the way we form our expectations when it comes to the exchange rate is to listen to the Zamna man, is to listen to the Alaji in the corner. And I think that's where the problem is. If you have a country whose trade surplus has doubled compared to last year, if you have a country whose current account has increased from a mere $66 million last year to over $2 billion in the first quarter of this year, why are you surprised when the exchange rate is showing stability? And so my point is, please look at the data, the media. Focus on the data. When you are forming your projections about the exchange rate or whatever variable, look at the data. It's all there. But you notice that in Ghana, we say the exchange rate is going down, and so it keeps going, it keeps going. You notice that trend? And I kept saying that no. When it moves, it's actually protecting the country against external shocks. And so it must move. But it appears it's all about what somebody thinks, and then we all go in that direction. So tomorrow, the moment the Zamra man says, hey, the city will start appreciating again, then everybody starts liquidating. If there's anything I want you to remember this morning, is that tell people that these things are macroeconomic variables. They are driven by macroeconomic factors. So just look at the data. And we churn out a lot of this data. We update it all the time. use that to form your projections about the exchange rate. And if you do that, I believe there will be no doubt in your minds. I have some prepared speech here, so I'm going to read through it. I'll give you some figures to underscore what I'm saying. But again, I cannot emphasize it enough. The way we are forming expectations in this country is not the best. It's all about what somebody thinks, what somebody says. It's never about what does the data say. And that's what I'm saying. If a country's external sector is so strong, why do you have doubt about the exchange rate? Right? The level of international reserves is over 11 billion. Right? Over 11 billion. It's now at 4.8 months of imports cover. And the press is arguing about how much intervention was done in the first quarter. And I'm like, they don't have anything to talk about? Talk about what the figure is now. You have over 11 billion, dollars. Compare that to what it used to be. 4.8 months of imports cover is no joke. Under the fund program, we were expected to build up international reserves to the tune of around 400 million by the end of June, for the first half of the year, end of June. Under the program, we were required to build up around 400 million. But do you know how much we built up in that first half? 1.6 billion. So why don't we talk about that? But rather talking about, did we pump 1.4 billion into the markets? And I'm like, please, can we raise the argument? Can we raise the debate? It's about what it is now. And talking about our interventions, many people don't understand what we do. We ensure that we are not using our reserves, right, to support the market or whatever it is. But about the Gold for Reserves program. Formerly, the gold business, for example, those export revenues used to accrue to commercial banks, right? But under the gold board arrangement currently, those flows are accruing to the central bank. So it makes sense to support the markets. Where is the sin in this? It's just we have to support the market because it's as though we've taken over flows that were going to the markets anyway. And so that is what we do. So my point is, look at the data, please. Read about our external sector performance. Look at projections going forward. And that should inform whether it will be sustainable or not. So permit me to quickly run through my prepared speech. Unfortunately, I'll have to leave by 50 minutes to 9. I have to be out of here. But let me introduce some of my advisors who are here with me. They will stay with you. They will join the debate. They will join the conversation, and they'll bring back a report for me later. Dr. Kwachi is one of our advisors. Dr. Kwachi, you want to wave? Please acknowledge him. He is helping us on monetary policy. And then we have a member of the Monetary Policy Committee, Professor Texan, seated right by his side. We also have Mr. Belnier. Some of you who have served in the industry would know him. Mr. Belnier used to be the head of banking supervision for many years. He paid his dues, but we decided to call him to come and, assist on issues about financial stability. Gentlemen, thank you for coming. So, distinguished colleagues, Managing Director of Graphic Communications Group, Chief Executive of Stanbic Bank Ghana, invited guests, ladies and gentlemen. I will begin by commending the graphic business and Stanbic Bank Ghana for yet another timely and thought-provoking edition of this flagship breakfast series. This platform has become a vital part of our national economic discourse where ideas are tested, where assumptions are challenged and where the policy-business interface is strengthened in the public interest. So your theme for today, that is sustaining forex gains, business economic impact. This theme could not be more relevant. The theme reflects not only the macroeconomic transformation that is underway in Ghana, but also the central question on many minds. And the question is, can the recent strength of the cedi be sustained, and how it would be translated into meaningful business outcome? So again, as I said earlier, it's not about the strength of the cedi, because it cuts both ways. Our objective is to ensure that in real terms, the cedi is not misaligned. So whether it is coming down or going up, we monitor what we call the real effective exchange rate. That is what matters. And at every MPC, the graph is shown. We, analyze it, we scrutinize it to make sure that we are comfortable about the positioning of the exchange rate. So we don't just let it go where it's going. We are watching something behind it. So, colleagues, the Ghanaian economy has over the last 3 years endured extraordinary shocks ranging from the domestic debt exchange program, as you know, all the way to global financial tightening and fiscal slippages driven by excessive borrowing. These events tested the very fabric of our macroeconomic architecture. As you remember, inflation soared, the currency weakened sharply, and public confidence wavered. But since we came, and through decisive reforms spanning fiscal, monetary, and institutional, we have reached a critical turning point. Today, the cedi has not only stabilized, and I did not say strengthened, stabilized. It has strengthened significantly, supported by robust external buffers, prudent monetary policy, coordinated fiscal consolidation, and renewed investor confidence. We now have to move from stabilization to sustainability and from headline gains to real sector benefits. And that is the heart of our conversation this morning. So let me begin by outlining the facts. And as I mentioned, this type of conversations should be based on the facts. The local currency has appreciated by over 42% year to date, that is as at end of June 2025, and has reversed nearly all the losses that were incurred in 2022 and 2023. Our gross international reserves now stands at $11.1 billion. And as I said, accounting for about 4.8 months of imports cover, which is up from 8.98 billion at the end of last year. We recorded a trade surplus of 4.14 billion in the first 4 months of 2025, with exports growing by over 60%, mainly from gold, cocoa, and oil. And I must admit, given the vulnerabilities that arise when your economy is virtually based on the exports of raw commodities, then you have to take measures to protect against the shocks that could arise. And let me say that we are currently working on a price hedging program, such that even if gold prices ultimately suddenly fall, we are able to limit the consequences therefore. Now, the current account surplus improved significantly to 2.12 billion as at the end of the first quarter of this year, and you can compare that to a mere 66 million during the same period last year. On remittances, Inflows remain resilient, even though we have noticed some decline from April, and the Ghana's IMF-supported program has passed successive reviews. As you are aware, the 4th review was just concluded. We have had our sovereign credit rating upgraded, which was very welcome news. We're sure that before the end of the year, there will be further upgrades, and ultimately we should be ready to reopen to the international capital markets. Now, these outcomes represent more than just statistical improvement. They are a restoration of macroeconomic credibility, the kind that markets, that investors, and that citizens respond to with confidence. So, how did we get here? At the Bank of Ghana, we maintain a firm disinflation stance since we came in, raising and holding the monetary policy rate at 28%. We conducted active open market operations to absorb excess liquidity, and we enforced discipline in the foreign exchange market through structured FX auctions and forward guidance. One of the things we have introduced is greater transparency to what we do. And so for the past MPC sessions, we've welcomed a number of stakeholders from out there who want to observe what we do. And I must admit, what we do is highly technical. It's much more than a lot of people think of.
Yeah, kwaje ensem no aba obetimi eja comment comment section e dey on mejebre na makenkan ni na e dey awon mo amodofo Snowy e na betima say e dey ensem no e bre no Ghanatube so sisi ade makram.